Good evening and welcome to another episode of Night Markets. Financial markets close at 5 p.m. and night markets open at 6 to widen the conversation. Each week I'll be giving you my perspective on what's driving markets as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. So during the week, optimism over Donald Trump's re-election and the Republican sweep of Congress fueled market gains. Investors expect corporate tax cuts, deregulation, and faster earnings growth, which drove major benchmarks to all-time highs. So while Trump's plans for higher tariffs and tighter immigration policy may create inflationary pressures, the overall economic impact will depend on policy implementation speed and scope. So before we get into macro and markets, let's just check in on the current situation in the Middle East. Renewed violence in Gaza saw Israeli airstrikes hit the Mawazi region, killing children at play and pushing the civilian toll much higher. Palestinian officials reported 44 fatalities in the last 24 hours alone. Global efforts for ceasefire led by the US, Egypt and Qatar achieved limited progress during the week. Qatar hinted that it might exit negotiations unless both sides commit more fully, as tensions rose after a US request to shutter Hamas's office in Doha. Additionally, a global food security committee warned of potential famine in northern Gaza, raising humanitarian concerns amid ongoing hostilities. And then moving to markets and macro, starting in the US. The US election dominated the market movements during the week, overshadowing most of the other economic events. The other highlight in the calendar was the Federal Reserve decision on Thursday, where the Fed lowered its benchmark rate by another 25 basis points, marking its second cut since mid-September. Fed Chair Jerome Powell avoided speculating on future fiscal policy impacts, but reiterated his intent to remain in office despite any presidential pressure. On the economic side, we did see some resilience, especially in the services sector, with the ISM Services Index rising to 56, the highest we've seen since August 2022, while manufacturing lagged amid severe weather and pricing pressures. Treasury yields fluctuated with the election results, closing lower overall after the Fed's rate cut on Thursday. The Russell Small Cap 2000 index surged by 8.5% for the week, while the S&P 500 gained 4.66%, marking its strongest performance in nearly a year. And then moving across the Atlantic to the UK and the Eurozone, the Stoxx Europe 600 index ended 0.84% lower, weighed down mainly by uncertainty over US trade policies under President-elect Trump. The Bank of England cut its benchmark rate to 4.75%, citing slowing inflation and weak growth. Governor Andrew Bailey did signal that further gradual cuts may follow if conditions persist. In another sign of the current dislocation with the various central banks, the Riksbank in Sweden lowered their rates by 50 basis points to 2.75%, with the potential for more cuts, while Norway's central bank held their rates steady. On the economic data front, the Eurozone PMI rose slightly to 50, indicating stable business activity with services growth outpacing a slower manufacturing contraction. And then moving further east to the Asia-Pacific region, Japanese markets climbed with the Nikkei 225 and the Topix indices both rising by more than 3.5%. The US election and the Fed rate cut lifted investor sentiment despite a strong yen pressuring exporters. The yen ended the week around 152 yen to the dollar, strengthening from 154 the previous week. China's markets also rallied after new stimulus measures and debt restructuring plans. The CSI 300 rose by 5.5% as exports surged 12.7% year-over-year in October. Beijing's further 10 trillion renminbi local government debt restructuring plan signaled a renewed push to stabilize growth in the economy. Then moving back home, it was fairly quiet on the economic front. We did, however, see some consumer sentiment data. These actually showed signs of a recovery ahead of Black Friday, driven by hopes for higher retail activity in the FMCG, tech and durable goods sectors. However, rising living costs and job insecurity continue to weigh on many households. Looking at the markets, the all-share index fell by 1.25%, led by declines in the resources and industrial sector. The rand ended flat for the week at 70.59 to the US dollar, following a sell-off after President Trump's re-election. And then just looking at the week ahead, markets will focus on inflation data out of the US to assess shifts in the economic outlook post-election. Investors will also tune into the Federal Reserve official speeches, of which there are a number during the week, following last week's rate cut. In the Eurozone, we'll see GDP growth out on Wednesday, as well as German CPI figures, which will take center stage. And then, as always, we'd like to end off with an interesting investment conversation we had during the week. So with the recent Trump sweep in the US elections, it's widely expected that the trade wars will escalate, which could have a detrimental effect on inflation. The tariff wars of the 1920s, particularly after the passage of the Smoot-Hawley Tariff Act in 1930, played a significant role in exacerbating the Great Depression. These tariffs were aimed to protect American industries from foreign competition by imposing high taxes on imported goods, but they had several unintended and harmful economic consequences. Firstly, the high tariffs made it more expensive for foreign countries to sell their goods in the United States, which prompted them to retaliate by imposing their own tariffs on American products. This mutual increase in tariffs led to a steep decline in global trade, reducing demand for American exports and significantly hurting US industries that relied on international markets. Higher tariffs made imported goods more expensive, which was intended to encourage Americans to buy domestically. However, this drove up prices on a variety of goods, reducing the purchasing power of American consumers and actually deepening the economic contraction, as people could afford less and thus also spent less. These factors combined to weaken the US economy and in turn contribute to the deepening of the Great Depression, both domestically and internationally. So the tariff wars actually stand as a cautionary example of how protectionist policies can have unintended and far-reaching economic consequences, especially in a globalized world. So as we've alluded to before, history doesn't always repeat, but it often tends to rhyme. So thank you for joining me for another episode of Night Markets. Financial markets close at 5 p.m. and night markets open at 6 to widen the conversation.